Prepayment journals are processed when a company pays for goods or services in advance. As a result of paying in advance prior to receiving the goods or services, it means that the counterparty who's received the payment effectively owes the company a certain value in goods and services. Similarly, it also means that the company has a current asset in the form of goods or services that they've already paid for, but that they will only receive in the future. So that is a current asset of sorts. Let's do a bit of an example in order to show how that would work. So, in order to ensure that the electricity supply is not cut off, MacMart has decided to make an additional payment to the electricity company. All of MacMart's payments are up to date at this point, and there are no amounts outstanding or unpaid. MacMart will pay an advance payment of 20 million to the electricity company at the end of the year. And this amount represents a month's electricity supply. What would the journal entry processed be? This is a prepayment. MacMart would debit electricity prepayment that is in the balance sheet, and it would be reflected as a current asset. The debit would be for 20 million. Because they've paid for it, the credit would be to the bank and cash. So there would be a 20 million credit to the bank and cash. And if you had to see the journal reflected in the T accounts and GL, you'd see a debit of 20 million in the prepayments for electricity T account and a credit of 20 million in the bank and cash T account. In the event that come the following month, MacMart elected to apply the prepayment to settle the electricity bill for the company, this would be the journal processed. So they're taking that prepayment and saying, we've paid in advance, we're no longer going to be in advance, we're going to use this money, the prepayment, to pay for the current electricity bill. They would debit electricity expense, again, 20 million in the following month, and then they would credit the electricity prepayment current asset on the balance sheet by 20 million. The effect of this journal would be to show the electricity expense in the following month, and by applying the settlement of this to the prepaid current assets, it would reduce the prepaid current asset to zero. Very, very simple, very, very straightforward. Let's do another example. Little Harvards is a private nursery school company in Johannesburg. Parents are required to pay fees in advance every quarter or every 3 months. At the beginning of the year, on the 1st of January, Little Harvards had received $12 million in fees. What would the journal entry that Little Harvards would process? One, they would debit the bank and cash 12 million. All right, the debit is in the balance sheet to show that they'd received 12 million. And then they would credit prepaid fees, 12 million. Prepaid fees are in the balance sheet as a current liability. They have received the money, but they have not yet rendered the service. If you had to see the journal reflected in the T account in GL, you'd see a debit of 12 million in the bank and cash T account and a credit of 12 million in the prepaid fees T account, representing a liability. At the end of January, Little Harvard would process the following journal, because now 1 month has passed and they've rendered 1 month of the 3-month service. They would debit prepaid fees in the balance sheet, that liability. They would reduce it by 4 million, and they would credit revenue in the income statement by 4 million. What this entry does is it effectively shows Little Harvard having earned the revenue for 1 month, and as a result also reducing the liability or amount owed to parents for fees paid in advance. Now, an identical entry would also be processed in February and in March, resulting in the full amount being reflected as revenue and no liability or amount owing by Little Harvard to the parents who initially paid in advance at the end of the first quarter.